up to 7.21% investment grade yield at qualified dividend tax rates. Are our top 3 preferred stock picks too good to be true? Hello everyone, and welcome back to our Base and Boost mini-series. So, we've been getting a lot of questions in the current environment about where investors might be able to find yields above 5% with investment grade credit risk. Now, if you are open to alternatives beyond classical bonds, one of the first instruments that comes to mind is preferred stock. We've spoken about preferred stocks before on this channel. Not only might they pay higher yields, their payouts may, for the right companies, also benefit from taxation as qualified dividends. So, for example, Fidelity's preferred securities screener here showed me 68 investment-grade preferred securities. And when we narrowed it down for real operating companies, those that might qualify for qualified dividend taxation, more about that later, and then sort by their current annualized dividend yield, these 3 investment-grade preferred stocks here came out at the top. Massachusetts Electric, symbol MSSEL, with a Moody's rating of Baa3, an original coupon rate of 4.44%, and an annualized dividend yield of 7.21%. Wells Fargo, symbol WFC/PL, with a Moody's rating of Baa2, an original coupon of 7.5%, and an annualized dividend yield of 6.3%. And this one from Connecticut Light and Power, symbol CNTHP, Moody's rating Baa2, original coupon rate of 6.56%, and an annualized yield of 6.27%. Now, we don't own any of these preferreds at the moment, nor did we go through the prospectuses for each of them in detail. As Chen often says, we're still very much in the growth phase with our personal portfolio. So, if you might be considering clicking the buy button on any of the preferreds that we will be discussing today after watching this video, be sure to do your own due diligence. Everyone's financial journey is different, and you will need to make your own decision. From what we could see though, all 3 of these preferreds appear to be legitimate quotes. Massachusetts Electric and Connecticut Light and Power are regulated utilities that trace their history back more than 100 years and are now subsidiaries of Eversource Energy, which is listed on the New York Stock Exchange with a $25 billion market cap. And Wells Fargo is a GSIB, a global systemically important bank and the 3rd largest bank in the US, with a market cap of about $230 billion. Plus, as I said before, if some conditions are met, these dividends of up to 7.21% might potentially be taxed as qualified dividends, meaning at the advantaged rates for long-term capital gains. Please note that all these numbers are at the time of this taping, per close of business of May 8, 2026. The annualized yield will change over time, and past performance is no guarantee of future results or outcomes. Also keep in mind that we are not tax advisors. Please consult with your trusted tax and/or financial advisor about your personal situation. Preferred stocks can be complicated. So, with that in mind, here are the 3 topics that we'll be covering today. 1. What are preferred shares and what are their main advantages? 2. How many types or flavors of preferred stock are there? And 3. What are the potential downsides of preferred stocks? And what's our personal perspective? Let's get started. What are preferred shares and what are their main advantages? So, the first question, what are preferred shares? Preferred shares are also called preferred stock, preferred equity, or preferreds for short. And we'll use all these terms interchangeably for the purposes of this video. So, preferred shares are a hybrid class of securities. They are technically equities, but they have some important bond-like features as well. So, a mix between bonds and equity if you want. Or, as traders are often heard saying, preferreds are equities that behave mostly like bonds. And as if that wasn't confusing enough, many preferreds on the market come with some extra features and conditions on top. At Diamond NestEgg, we like to say that preferreds come in many flavors. But let's take it step by step, and let's start with the basics. Preferred stocks pay cash dividends that can often be higher than the interest for comparable bonds. And while these payouts are called dividends and paid quarterly rather than semi-annually or annually, like the interest on bonds, we can generally expect a regular and predictable payout from our preferred stock. Also, like a bond, every preferred share basically has a face value, a par value, as well as a fixed percentage for the dividend payout, just like a coupon. The only exception would be adjustable rate preferred stocks, but these are rare. So the regular bond-like payout is really the main reason why most preferred stocks behave normally like bonds, at least during the good times. Let's pick Connecticut Light and Power from before as an example. CNTHP preferred stock has a par value of $50 and a fixed rate, a coupon rate of 6.56%. And when we went on Yahoo Finance for a reality check, it turned out that at least since July 2004, the longest we could see the data, CNTHP was paying a constant dividend of 82 cents per share every 3 months, including through the downs of the great financial crisis and COVID. Which gets us to the next potential advantage of preferreds. While bond interest is always taxed at your full income tax rates, the dividends from preferred shares may be classified as qualified dividends by the IRS under certain conditions, which means that they may be subject to long-term capital gains tax rates, which are generally lower than tax rates on ordinary income. That's where the hybrid nature of preferred shares may work to the advantage of the investor. By combining a predictable regular coupon, almost like a bond, with the potentially preferred tax treatment of qualified dividends, like for equities. Now, before you rush out to buy preferreds, keep in mind that not all dividends from preferred stock may be considered qualified dividends by the IRS. The issuer has to be a domestic or qualifying foreign company, so there needs to be a strong link to the US. Plus, the underlying income must meet some conditions. Most importantly, the preferred dividend cannot just be the repackaging of interest income from an underlying bond portfolio or from a tax-exempt organization. For example, certain trusts, passive investment companies, or even REITs might issue preferred shares for capital management purposes, even though they don't really have a tax advantage. Finally, the investor, the owner of the preferred shares, also needs to meet a few requirements, including a minimum holding period of 61 or 91 days, depending on the circumstances. And if you're interested in learning more about what other like-minded, safety-oriented investors are buying for stability and predictability, as well as for higher growth, come on over and join the growing member community in our VIP investment club, where these conversations are happening practically every day. Use coupon code INCOME2026 at checkout to get $100 off our private VIP investment club membership before Sunday, May 17th. Visit our website at www.diamondnestegg.com and click on this yellow Private VIP Investment Club button to learn more. I've also linked everything below this video for your convenience. The $100 coupon code INCOME2026 can also be used for our popular bond course bundle. And again, please keep in mind that we are not tax advisors. Always consult with your trusted tax and/or financial advisor for your personal situation. So now we know what the main advantages of preferred stock are. Let's now look at the types of preferred stock out there. How many types or flavors of preferred stock are there? As I said before, there's quite a bit of variety out there. We've drawn up this table of different types of preferred stock to give you an overview. So when you look at these various types of preferreds, keep in mind that in a way it's even worse than it looks, because these various different types of preferred stock can be combined with each other. So, for example, you can even have preferred stock which is convertible, cumulative, and voting all in one. Plus, as far as we know, nothing would really stop issuers from coming up with new clauses and variations. So always make sure you do your due diligence and read the fine print for the preferred stock you may want to consider buying. But back to our table. So the basic preferred stock is straight or regular preferred, as the market calls it. This is basically what the preferreds that we discussed earlier in this video are. Regular preferred stock pays a fixed dividend, but it can be reduced or skipped at the discretion of the issuer. Now, most companies will try to keep paying the dividend on their preferred stock as long as they can. But at the end of the day, it's fixed until it isn't, if we want to say it like that. And one more point. Regular preferred stock is issued in perpetuity, has no maturity date, and also carries no voting rights. Cumulative preferred may still skip dividend payments, but any such missed dividends will accumulate and must be paid in full to the preferred stockholders before any dividends can be paid again to common shareholders. This is clearly not an ironclad guarantee, but may offer a certain degree of protection. Participating preferred equity participates to some degree in the financial success of the company. Usually, this is done by paying some extra dividend on top of the regular coupon if certain financial goals are met. Convertible preferred is a sometimes popular type of preferred equity that gives the shareholder the option to exchange their preferred shares into common stock at a predefined exchange ratio. So, for example, the owner of convertible preferreds may have the right to exchange 3 preferreds into 1 share of common stock, and this conversion is at the discretion of the shareholder. For callable or redeemable preferreds, it's the other way around. Here, the issuer has the option to redeem the shares at a predefined price, often after a specified no-call date. So, for example, a not unusual arrangement for a callable preferred would be redemption at par at the discretion of the issuer after an initial no-call period of maybe 5 to 10 years. Adjustable rate or floating rate preferreds are rare, but they exist. As the name suggests, they don't carry a fixed coupon, but their dividend rate fluctuates, usually based on a benchmark interest rate, pretty much like a floating rate bond. Voting preferreds have some voting rights on certain topics or when a condition is met. For example, some preferred shares will start giving you voting rights if the preferred dividend has been missed over a certain period of time. This is essentially done to give investors in preferred shares a certain protection in cases of financial difficulties for the company or even a restructuring. Listed preferreds are listed on a stock exchange and traded publicly. Preferreds that are not listed on any stock exchange can only be traded privately over the counter, if at all. And finally, qualified preferreds. Now, this is not a technical term. That's what we call them. Those are preferred shares that meet the IRS requirements for qualified dividend in terms of the issuer conditions, as we've discussed before. Remember though that the owner still needs to meet their own requirements as well to benefit from the potential treatment as qualified income. So now that you have a feeling for how preferreds work, what their potential advantages are, and what types of preferreds are out there, let's move to the next section of this video. What are the potential downsides of preferred stocks? And what's our personal perspective? The market for preferred stocks is not very big. We couldn't find one single authoritative source, but the volume of listed preferred shares in the US stands at probably around roughly 200 billion. In addition, there may be an additional 300 to 400 billion in non-listed preferred shares out there that can only be traded over the counter, OTC, if at all. But even if we take those two segments together, we get to maybe 500 or 600 billion in volume, which is only about 1% of either the total equity market capitalization or the total bond market volume in the US at the time of this taping. So these relatively modest volumes mean that liquidity may be limited, even for listed preferreds, and potentially even more so for non-listed preferreds. That said, if you're interested in preferreds and don't want to invest via a fund, listed preferreds may still be the best starting point. They can usually be bought and sold by retail investors like you and me via leading brokerage firms. For example, I showed you Fidelity's preferred stock screener at the beginning of this video, and Schwab has a similar tool that allows you to screen and trade preferred stocks. Now, in our mind, these tools are not always quite as intuitive or easy to use as for regular bonds and stocks, but we got used to them over time. The offerings that you may find on these tools will mirror the market. The most active issuers of public preferred stock in the US are banks and other financial companies. And that's because banks in particular like the hybrid nature of preferreds, that they combine an almost bond-like fixed coupon in normal times with the recognition as regulatory equity in their capital structure. In other words, when a company enters into difficulty or even goes into liquidation, preferred equity is still equity. This means not only that the issuer may reduce or suspend the dividend at its discretion, but if worst came to worst and a company was to enter liquidation, preferred equity will rank behind all bonds. The preference in the name really only means preferred versus common equity, not versus even the lowest ranking bonds. So it may not be surprising that the S&P US Preferred Stock Index shows that as of the end of April 2026, 65% of preferred stocks were issued by financial companies. Next, at almost 12%, come preferreds issued by information technology companies, followed by industrials at a bit more than 7%. And utilities, despite their popular appeal as regulated, steady issuers of preferreds, only come in 5th place with about 3%. So, when you really follow up on the idea of investing in preferred stock, be prepared to hold a lot of banks and financial names and probably a few industrials and utilities as well. In addition, some information technology companies seem to have discovered preferreds as one way to finance the current AI investment boom. Although it seems IT firms prefer convertible or other hybrid preferreds over the basic type that we're focusing on in this video. And we'll leave non-listed and private preferred stocks aside for now, as they are generally not readily accessible to retail investors. Private preferreds, by the way, are also one of the most common tools to finance startups. So we personally don't really own much in the way of preferreds in our portfolio. As I mentioned earlier, we are still focused on growth, and that's not what preferreds are designed to deliver. Everyone's financial journey is different though, and you may want to consider preferreds if you can check the 5 boxes below. First, and most importantly, you're focused on investments that may deliver a potentially attractive income stream. And this argument may be especially strong if you are planning to hold your preferreds in a taxable account where you might potentially benefit from the classification as qualified dividends. 2. At the same time, you are not dependent on that extra income. Or, as we would say at Diamond NestEgg, preferreds generally belong in the boost part of the portfolio for their potentially higher yields, not the base, where safety, stability, and predictability are most important for building out a guaranteed lifetime income stream. Remember, even though most companies will try to keep paying for as long as they can, at the end of the day, the dividends on preferreds can be reduced or suspended at any time at the discretion of the issuer. And if at this point you want to join a trusted private setting to see how other members and super savers like yourself may be building out their portfolio, and not just with preferreds, but with other safe, stable, and predictable income sources in their base part of the portfolio, as well as higher yielding assets in the boost part of their portfolio, don't forget to take advantage of our May sale. Use coupon code INCOME2026 at checkout to get $100 off your private VIP investment club membership before Sunday, May 17th. Visit our website at www.diamondnestegg.com and click on this yellow Private VIP Investment Club button to learn more. I've also linked everything below this video for your convenience. The $100 coupon code INCOME2026 can also be used for our popular bond course bundle. Moving on to 3 now. You plan to hold your preferreds for a longer term. Given the small volumes and the small market size overall, the liquidity of preferred shares may be limited, even if they are listed. Remember, normal or straight preferreds don't have fixed maturities, so you can't count on a full repayment of the principal, but may have to accept whatever the market price may be when you want to sell them. 4. You can accept that preferreds trade more like bonds, have credit risk, and generally have a limited upside. They are not tools for growth and wealth creation. And in case of liquidation, preferreds come behind even the lowest ranked bond. And 5. You're prepared to deal with the complexity of preferreds. The mixture of equity and bond-like features is complicated to start with, and the many different types and flavors of preferreds out there can make it even more confusing. So, do you own any preferreds in your portfolio? And if not, what do you think about them as a potential source for higher yields in the boost part of your portfolio? Leave a comment below and let us know. Thanks for watching, and see you again soon.